A very good evening, my fellow traders. Today I'm here talking about how do I integrate employed volatility in my trading strategy. And this is something which has become core uh, to my strategies and something which I wanted to make a video for a long time. So finally, here I am. Now, there has been a lot of geopolitical tensions. There has been talk of large hedge funds manipulating the markets. The fact remains that we cannot do anything about any of them. So what we can do is how do we learn from that and integrate this volatility in our trading strategy. So there are days when we have seen that all the premiums keep on going up. There are days when suddenly there is a decay in the premium and traders are perplexed. So that made me change my own trading style, and here I am sharing some of that insights with you. So before I start, let me talk very briefly about what is implied volatility. For that, we need to understand the basic factors that impact an option premium. So, how do we decide how much premium should be there for a particular option? It's a combination of mathematics and psychology. So, let me quickly talk about the factors which impact mathematically. There is no ambiguity there. One is where are we in terms of the underlying? How far is the strike? So, basically, the strike that we are trading and underlying combination determines how much is the moneyness of the option or how far it is, thereby what is the risk. So that is one factor. The other thing is what is the time to expiry. So more the time to expiry, higher would be the premium. Closer the time to expiry, lower will be the premium. So that is the another factor. And then we factor the interest rate or the dividend in certain cases, or a combination of interest rate and dividend, because here you are taking a position without putting all the money. So in a way, a market is financing that for you. All these are known factors. There is no ambiguity here. We know exactly when the option contract is going to expire. We know exactly what is the strike that we are trading. We know exactly at the time we are taking the option trade, what is the underlying value. Now, where does the psychology comes into play? The psychology is we don't know what is going to happen in the future, not only in terms of the direction, but in terms of the overall uncertainty in the market. When there is uncertainty in the market, we want to sell option at a higher premium because there is a higher risk in that particular thing. We know there is less uncertainty, then you may be okay with selling the option at a lower premium. That factor of uncertainty that is baked into the price is more of a psychological and not a very objective thing. It is a bit subjective thing. But that is what we are calling implied volatility. Implied because this is at the time of pricing the option, it is not known how the incidents will play out. So we are implying or estimating a particular volatility in the option premium. So basically, the option premium is a factor of underlying spot price, how far is the strike or which strike we are trading, when is the expiry, what is the interest rate or the risk-free interest rate and the dividend in the economy, and the implied volatility. Now, all the other things are known. Implied volatility is not known. So the way we compute is we know the option price and then we back calculate the implied volatility. तो हम option price से implied volatility को compute करते हैं, क्योंकि हमें अगर पहले से आपने कह दिया कि implied volatility is let's say X percentage, तो आपको पता चल जाएगा कि मेरी option premium कितनी होनी चाहिए. So that if you are already implying a particular volatility, बट दूसरा फैक्टर है कि देर इज अ डिमांड सप्लाई एंड ऑप्शन इज गेटिंग ट्रेडेड. सो ऑप्शन प्रीमियम से हम ये पता लगा सकते हैं कि इस प्रीमियम में वोलेटिलिटी कितनी फैक्टर की गई है. आई होप दिस इज ऑल क्लियर टू यू. अब हाउ डज इट मैटर? इट मैटर्स अ लॉट, क्योंकि हमने जितना वोलेटिलिटी फैक्टर किया था वाइल प्राइसिंग द ऑप्शन, अगर इन रियलिटी द वोलेटिलिटी गोज अप or volatility remains higher than that, which is called the realized volatility, तो obviously keeping all the other things constant हमें नुकसान होगा. और अगर जितना volatility हमने factor किया था, if the actual volatility turns out to be lower than that, then as an option seller you will benefit, keeping all the other things constant. Of course there is a matter of direction and everything else, but it is like you have sold an insurance premium. अगर बंदे ने एक्सीडेंट कर दिया तो इंश्योरेंस जिसने बेचा है उसको घाटा होगा, और बंदे ने अगर एक्सीडेंट नहीं किया तो जिसने इंश्योरेंस बेचा है उसको फायदा होगा. So as simple as that. So we are estimating a volatility which is called implied volatility. If the actual volatility turns out to be higher than what we estimated, as an option seller, it will be uh, losing proposition, and as an option buyer it will be winning proposition. So इस चीज को मद्देनजर रखते हुए हाउ डू वी बेक इन आवर ट्रेडिंग स्ट्रेटेजी, उसका मैं आपको अपना सेटअप बता रहा हूं. और आई कैन टेल यू समथिंग. आई मीन आई नॉर्मली डोंट टॉक टू मच about myself or the kind of content I bring. But I am telling you, अगर कोई भी जो बड़े बड़े इन्फ्लुएंसर्स हैं, जो मैं बताने जा रहा हूँ वो पढ़ाने के लिए आपसे कम से कम 50,000 से 1 लाख रुपए चार्ज करेंगे, उससे कम कोई चार्ज नहीं करेगा. तो मैं आपको फ्री में ये बता रहा हूँ. तो प्लीज पुट सम फोकस. एंड आई नो दैट थिंग्स दैट कम फ्री पीपल डोंट वैल्यू इट, but request you to value it. And if you like it, then please subscribe to my channel and share it with friends and family. Okay, so let me share my screen and let me tell you what are the things that I do and how do I factor this entire thing. Okay, you can see the setup that I use. This has 4 quadrants in this chart. The first thing that I look is the Nifty 50 index. The second thing is, after the day open, I put the straddle chart. So you can say this is the Friday chart. So on Friday, when we opened, the straddle or the ATM was 24,800. So I have the 24,800 straddle chart on this. I also put a put chart, ATM put, 24,800 put, and 24,800 call option. Now on this chart, what do I look? So basically, I look at what is happening on Nifty. This straddle is more of a reference point for me, which in some ways tells me about the volatility. Or if I have taken a straddle trade, it tells me what is happening to my trade. But I look at these 3 things. I look at Nifty chart, I look at Nifty put option chart, and I look at Nifty call option chart. And I look at implied volatility. Now I will go one by one and explain everything to you. Based on my read or the study that I have put in or the indicators that I have put in on these charts, I try to determine for Nifty, Nifty put option, and Nifty call option that each of these 3, are they bullish, are they bearish, or are they sideways? And I'll tell you the indicator that I use, but you can use your own system to determine. But essentially the answer is Nifty bullish, is Nifty bearish, or is Nifty sideways? Nifty put option bearish, bullish, or sideways? Nifty call option bullish, bearish, or sideways? But before I even get into there, I try to determine, is IV increasing or is IV decreasing? So the basic thing is IV bullish or is IV bearish? Now, how do I determine that? There are a few things which I do. Okay. So one is, I will show you the sensible. I know most of the traders have sensible available because of your brokerage thing. So in sensible, if you go to analyze and then you go to live option charts, you see something like this. Of course, there are multiple widgets here. So you can go to the settings, and in settings, you can select what all you need. So you can see I have selected option IV and I have selected IV percentile. I also have the open interest, but that's not something which is of concern in this particular video. So for this particular purpose that I'm explaining to you, let's select the option IV and the IV percentile, these 2 things. Okay. So analyze live option chart, and then in that live option chart, we are selecting IV and IV percentile. This is available on Sensible. With most of the brokers, it is available for free. Now, the thing you have to keep in mind, I trade on a 5-minute time frame. It is an intraday trade. So you can automatically select the expiry. In that case, Sensible determines, but sometimes on the expiry day, it will select the next week expiry. So what I do is I manually select the expiry which I am trading. So I was trading 26th June expiry on Friday. So I selected 26th June, and IV percentile also I selected. Now, what is IV percentile? IV percentile tells a relative picture for that particular option. So this is the Nifty, and we are looking at the Nifty ATM IV. This is the average of the put and the call IV. And the percentile tells that relative to its historic value, is it high or low? So if it is 99 percentile, which means that the current value is higher than 99% of the occurrence. If it is 60 percentile, then it means current value is higher than the 60% of the occurrences. So two things I look at when I look at IV. One is the absolute value relative to its history. So that is the IV percentile. And the second is the trend. So if IV percentile is high, so for example, on Friday, let's see how far it can take us back. Okay. Okay, I'm just going back. This is 5-minute chart. So you can see that IV percentile was 40.4 and the ATM IV was 13.1. And as you can see, this slope was downward. Okay. Now, of course, you have to go deeper. But ideally, if I say that IV is falling, IV percentile should be higher. Ideally, it should be greater than 90 percentile and it should be falling. And when I say IV is going up, then ideally it should be lower, say 60 percentile or low, and it should be increasing. But you don't get into ideal situation all the time. Ideal situation gives you high probability trades. But if you have to take a trade, you don't necessarily need to wait for the high probability trade. In that case, you can just look at the IV direction. So as we can clearly see that 10.25, the IV was 13.1, then it was falling, it was then sideways, went up a bit, falling. So overall, if I look at Friday, the IV was bearish. It was a bearish trend. There is a bit of subjectivity in it. Okay. So this is how you look at IV and you determine whether it is bearish or bullish. The ideal situation is IV percentile is high, higher than 90 percentile and on a falling trend. That means it is bearish. Bullish scenario is it is lower and then it is increasing. It's a high probability. Otherwise, it is just the trend you look at it. Is it declining or is it increasing? The other way to look at IV is, so let me blow up this particular Nifty chart here. Okay. And other way to look at is my VIX indicator. I'll just tell you there are different indicators, but this indicator is the VIX indicator. I've talked about it before in my videos. This is nothing but on India VIX. I have put in two moving averages, fast and slow moving average, and then tried to determine. So if you see when it is red, that means VIX is falling. Now, the difference between IV and VIX, a lot of confusion. VIX, or the India VIX rather, factors only Nifty while computing, factors only Nifty IV while computation. Now, IV is true for any instrument that is traded in the derivatives market. So India VIX is only Nifty. So if we are trading Nifty, then definitely you can look at India VIX as a proxy for the IV chart, with a caveat that the weekly options are not factored in the VIX. VIX factors only the current month option and the current plus 1 month option. Whereas what we are trading is a particular week's expiry. So from that perspective, IV is a more reliable. But if you don't want to look at two different screens, or you want an additional confirmation of what you are seeing in the IV chart, which I just showed, then you can additionally look at VIX. So when I looked at VIX on Friday at 9:15, it was on a falling trend, and only towards after 13:15, it became a little bit rising. Okay. So the first thing I look at is whether IV is bearish or IV is bullish. Okay. Then, as I said, I look at three different charts: Nifty chart, Nifty put option chart, and Nifty call option chart. So right now we are on the Nifty chart. So what do we look at it? Here I have put in some direction indicator, right? Of course, there is VWAP. There is a Lorentzian machine learning indicator, which I've talked in my previous videos. If you have not seen, please go and watch that video. I'll put the link in the description. So this gives, for example, here clearly we can see that the price was above VWAP and Lorentzian most of the time. So it was a bullish day on a Friday. So that is one. I also have developed something called Quantiple Direction Index, which is a freely available indicator on TradingView, which I have published. Even the source code is available. So I'm not getting into detail on that. Maybe I'll make a video on this particular indicator some other day. But it shows me when it is green, it is bullish. When it is gray or white, it is sideways. And when it is red, it is bearish. Okay. So I look at it. For example, you can see that on Friday, it turned into green at 9:40, and then it remained green for quite some time. At 12:20, it became sideways, and then it turned green. So it gives me another indication. And then the slope angle. Here I'm looking at the slope of VWAP. Green means the slope is upward trending, which means it is bullish, and the red is it is downward trending. So I use a combination of these to determine the direction, whether it is bullish, whether it is bearish, or whether it is sideways. Now, the same thing I do for the put option chart and for the call option chart. You may use any other trend following system that you have to determine. That is not something which I'm talking in this particular video. I just showed you what I'm using. You use whatever you're using, but ultimately you have to come to a judgment based on either your own price action based judgment or indicator based judgment, whether Nifty is bullish, bearish, or sideways. You have to answer this question. Okay. After that, I look at the put option chart. So if we look at the put option chart very clearly on Friday, no brainer, even if you would have looked in the morning. So right now, of course, in the hindsight, it is clearly bearish. But even if I would have looked at 9:30, 9:25, you can see that my direction index here was deep red, which was very bearish. The price was below the VWAP, below the Lorentzian. So even if 9:30, 9:40 or 10 o'clock, you would have clearly seen that on this particular day, the put was bearish. So that's the second thing I look at. Then I look at the call option chart. And you can put an ATM chart for the put or the call, or you can put a 100 or 200 points away chart. Both are okay. More or less, they will show you the similar direction setup. So here, clearly, the price is above Lorentzian, price is above VWAP. My Quantiple Direction Index is green. So the call option is bullish. Put option is bearish. Nifty is bullish. And the IV was falling. That was the setup on Friday. So having all the four information, what I have done is, okay, I have created something for my trade setup. Now I am sharing the way I have looked at the trade setup. I am not saying this is the way you do, but I'm just giving you a framework. So what did we say? So this whole setup is based on implied volatility in our view is bullish or implied volatility is bearish. So first you determine that. Then the three things, Nifty, underlying, Nifty put option, Nifty call option. So essentially each of those values, if the implied volatility is bullish, then potentially we can have 3 into 3 into 3 combination, 27 different combinations, right? Because Nifty can be bullish, bearish, or sideways. Put option can be bullish, bearish, or sideways. Call option can be bullish, bearish, or sideways. So essentially 3 into 3 into 3, 27 combinations are possible. But based on my experience, I have narrowed it down and I've eliminated certain combinations which either won't happen, or even if they happen once in a while, I don't want to trade. So at 9:30, 15 minutes into the day, I have to determine based on my setup whether the VIX that day or the IV that day is bearish or bullish. Nifty put option and call option. After I have determined, so let's say on Friday, I'm taking an example of Friday. So on Friday, implied volatility was bearish. Okay. Now let me see what trade I am taking. Underlying was, which was Nifty. Nifty was bullish very clearly. So Nifty was green. I'm just saying green for bullish. Put option. We saw put option was bearish. It was very clearly bearish. So I make it red. And then I say call option. Call option was very clearly bullish. So I mark it as green. So Nifty, first of all, you start with implied volatility. Implied volatility was bearish on Friday. premiums were coming down. Nifty was bullish, put option was bearish, call option was bullish. So it gave me the trade that I have to sell a put option. So once I input these four values after determining whether implied volatility is bullish or bearish, I input these three values and this Excel gives me the actual trade that I should be taking. So it told me to sell a put option. Then I have added, okay, fine, I go ahead and sell the put option. So when do I exit? What is my exit point? So my exit when I sell a put option is when the Quantiple Direction Index turn neutral. Because when I am selling that put option, it was showing red on the QDI. So half the quantity I will book when the Quantiple Direction Index turns neutral, and the other half I will exit when the put option 5-minute candle closes below VWAP. So in this particular case, I do half and half. There may be cases where I exit at the same time. So let me look at some other thing just to explain to you. I'm not going to prescribe or share this particular Excel. I'm giving a framework. It's very intuitive. You can determine. Okay. So assume that Nifty was green. Okay. It was going up, but the implied volatility was bearish, and we see, and it happens sometimes, that the call option was not going up so much. Call option was, let's say, sideways, or call option was also falling. So the Nifty was going up, put option was going down, which was bearish, and call option was also not going up so much. It happens many days. If that would have been the case, then what would have been my trade? Then my trade will not be shorting the put. Then my trade would have been to take a short straddle. If I would have seen Nifty going up, put option going down, call option also staying sideways to downwards, then I would have sold a straddle rather than selling a put option. And if the straddle on a 5-minute chart, the straddle chart, that is where I showed you in my master chart that I look at 4 different charts. So that is where I would have looked at the straddle. And when on a 5-minute, that straddle candle would have closed above the Lorentzian machine learning indicator, then I would have exited my trade. So this is how I have done for both implied volatility being bearish, implied volatility being bullish. Let me show you quickly to give you a little bit of an idea of what I am talking here. As you can see, instead of 27 different combinations which are possible, I have broken down. I think that when the implied volatility is going up, only in 9 different combinations I am going to take a trade. And most of those trades, I mean, 2 of those trades are long straddle. Sorry, 4 of those 9 trades are long straddle. The yellow one is low probability in terms of the occurrence. But if it happens, I'm going to make a long straddle. So typically, when implied volatility is bullish, Nifty is going down, put option is going up, call option is also going up. It can happen sometimes, though the probability of that happening is low. But you would see suddenly there is a fall in the Nifty. Both the option prices are spiking, both the call and the put. That time I would buy a straddle, that is the long straddle, and I will exit that long straddle if it closes below Lorentzian. However, the higher probability is Nifty is going down, put option is going up, call option is sideways. It is not going down. If that happens, again, I will create a long straddle. Once I have created a long straddle, I will not look at all those. Then I will look at that particular straddle chart. So once I take a trade, I only look at the chart of the trade taken. So if I have taken a long straddle or a short straddle, I will look at the straddle chart. If I have taken a long put or a short put, I will look at only a put option chart, and similarly the call option chart. So after taking the trade, so this entire thing I do before taking the trade. After taking the trade, how do I exit? It is based on that particular chart. So in this example, if I have taken a long straddle, I will exit the long straddle when it closes below the Lorentzian indicator. Similarly, let me talk about a few other options. When the implied volatility is going up. Assume that the implied volatility is going up and Nifty is going down. So Nifty is red. You can see this. This is being red. Put option is in green. Put option is bullish. And the call option is bearish. Nifty is bearish. Put option bullish. Call option bearish. And the IV is going up. In that case, I will not sell a call option. Rather, I will buy a put option. That is the time when I will buy a put option. Put option would be green. The QDI, which is the Quantiple Direction Index indicator, would be green at that point in time. I will exit when that QDI turns neutral after taking that trade. So I hope this entire setup was useful. I talked about, just to recap, that IV is something which is what is factored in the option premium, and you compute based on the option premium. If the IV is bullish, we are better off buying an option in general or buying a straddle. If IV is falling, in general, we are better off selling an option or selling a straddle. And to determine the exact trade that we take, I look at Nifty underlying, I look at Nifty put option, I look at Nifty call option. Based on that, I decide which trade to take. And for every trade, I have an exit option. Now, on intraday, I don't do spreads, but it may be a good idea to do spreads. So wherever I'm saying buy a call option, you can do a bull call spread. Sell a put option, you can do a bull put spread. So you can create a spread. It's entirely your wish. With that, I will close the video today. Wishing all of you a very profitable journey. And I also have one video. I had created a song. Of course, the song was made by an AI, suno.com. But I had worked on the lyrics along with the AI. I had put in a lot of effort. So that's a nice IV song, because in my view, I believe that a trader, an option trader, has to intimately understand the IV and the IV behavior. And once you have understood it, you have sorted out option trading. So that's a nice song. Listen to that also. I'm going to leave that link also in the description. Wishing all of you a very happy trading, very profitable trading. Thank you so much for watching my video.